Welcome to our High Rock Monthly video for August. I'm Scott Tomlinson, and with me on the call is our portfolio manager and the founder of High Rock, Paul Tepsich. And we're going to skip real quick and hopefully get this done in a hurry so you can all get back to your summer. But this is what happened in July. Interestingly, the gold, silver asset class was higher, better than everything else. Global equities were pretty strong in July. U.S. equities, Canadian equities were not as strong, but Canadian REITs did bounce back. The only things that were underperforming or were flat were the preferred share index, and then bonds continued to struggle with the advent of more interest rate increases coming, and we'll talk about that a little bit further in the program. But generally, balanced funds were up in the vicinity of 1.5% over the course of the month, and that should make most of our clients happy. Paul, any comments?
Yeah, the only thing I'd add is bonds. I think we said this last month, Scott. Government bonds yields were extremely volatile yet again, and even over the past, today's August 2nd, but yesterday and today, up huge one day, down huge the next day.
Yeah, and lots to talk about on that front. But just while we're talking about bonds in general, anything to comment about the downgrade of the U.S. Treasuries by Fitch?
Yeah, my view on deficit financing amongst these Western democratic nations is, unless one of them goes right off the rails with regards to over deficit financing that is beyond what any other nation is doing, I don't think it really matters much. I really don't. And today's probably a case in point. I mean, 10-year treasuries were 10 basis points higher, 11 basis points higher this morning at one point. Now they're only 5 or 6 higher. I don't think it matters a whole bunch. It's unless they do something absolutely insane, which it may seem insane today, but could get worse.
Right. Okay. Well, let's move on, because it was a pretty quiet week, I think, in the high yield front, right?
Yeah. It was a very quiet month. We didn't do any trades, and we did some additions in late June. We spent some of our cash that was sitting on the sidelines. That added some current income to the portfolios. But bonds were reasonably stable to maybe a snick up, but nothing, and there was no news to report on any bonds.
Okay, excellent. We always talk about this, but we're always focusing on the long term, and I've had a number of great client communications recently. We've had some clients just entering into their next phase of their lives after their jobs, and we've been working on wealth forecasts for them to make sure they've got the appropriate cash flow. So these are all the things that we work on, and I want everybody to feel comfortable getting in touch with us if there's been, or if there's going to be some change in your situation, and is it time to start looking at the structure and the strategy behind your portfolio, and do you need cash flow, and all of the things that we help work on here and make sure that you're living the life that you want to live after work. So anyway, feel free to get in touch if you have anything coming up or you want to chat about it. I'm here. Let's quickly jump into the things that are happening in the economy and that concern most folks out there. Paul, inflation continues to come down, but the Bank of Canada continues to push rates higher, and there's some talk that when they meet in September, they may raise them again. I think it's probably mixed, though, right, on the what to expect on that front.
Yeah, certainly a lot of the economists on the street seem mixed, but I think what's really interesting too, and I know Rosenberg wrote about this, but really, if you strip out mortgage cost increases to the CPI inflation data, you're down at 2%. So think about it. Like the number one thing driving inflation right now, the number one line item is mortgage costs. And that's why the Bank of Canada is hiking rates, and they're making it worse. So I'm not sure I understand their logic anymore. And if you look at this chart here, is obviously only 3 years. If we go back, I mean, on a real rate basis now, if you had overnight money at 5%, inflation's only at, call it 3%, that's 2% real rate. And I can't remember the last time we had a positive real rate between overnight and inflation. It's been decades. So rates are extremely cheap here right now. Of course, there's always a prospect that inflation could go up again, but at this stage, it's a pretty clear signal, and I'd say we're getting very close to the band that the bank wants to be in.
Yeah, I hear you on that, and not a dissimilar story in the United States. The Federal Reserve probably is finished hiking at this juncture, but again, that's remains to be seen. And the trajectory of inflation is continuing to go in the right way. Although, depending on who you talk to or whose articles you read, it could be a little stickier going forward, but that again remains to be seen. I think personally that from just looking at all of the input factors that are coming into future economic growth, it's going to be really hard to see the consumer with much spending ability as we go forward with the amount of debt service that they need to look after, and the fact that as we move forward, we probably won't see significantly higher unemployment, but there's definitely a good chance that there will be growing unemployment because companies have not, as they did at the beginning of the pandemic, let employees go because it was really hard to get people back. So they've been a little bit sticky on that, and but at some point, more profit margins are going to shrink enough that it's going to start to impact the unemployment rate and probably push it higher. So that's just my thought going forward. And to me, Paul, and you can agree or disagree, but it calls for at the very least, a mild recession. And if it steamrolls a little bit, that could be pretty tricky. And that would mean central banks have to start cutting rates again sooner rather than later.
Yeah, and I think that is the worst case situation. I think the softer landing approach would lean heavily on what we talked about a few minutes ago, which is massive deficit financing that remains in place on a relative basis in both Canada, the US, and throughout Europe. So there's the IRA Act in the US, the Inflation Reduction Act, the CHIPS Act. I think the US is going to have to move back towards manufacturing, but that is going to take a lot of time. A greenfield manufacturing plant doesn't just get built and operate in a month or two, or a matter of 1 or 2 quarters for that matter. So it's going to take time, and in the meantime, let's all hope we don't fall into a recession. But should we, that Fed funds rate we're looking at right now on the chart of 5.5 is going to drop precipitously.
Yeah, I agree. Okay, thanks for your input. Let's talk very quickly about global equity strategy. We have seen this before. Stocks get overvalued relative to anticipated or forward-looking or expected earnings, future earnings. That's happened again. Maybe not as extreme as it got in late 2021, but it certainly is. That differential is widening, and you can see it when you look at the fear and greed index. We've been pretty greedy for a good chunk of maybe the last 3 months, and now all of a sudden people are starting to take profits. So I expect that valuations are starting to look a little thin, and there's profit taking going on, and we could see the balance of the summer into the fall, and we all know that equity markets get more volatile in the periods of September and October, so we could see some considerable volatility coming. For the moment, as we rebalance, we're selling equity holdings and lightening up a little bit where we can, and we'll continue to be defensive when it comes to the equity market. Paul, you showed me a couple of these slides. I thought maybe you'd like to weigh in.
Yeah, this actually kind of layers in pretty well with the PE chart that we saw. Like, obviously, this is the Dow Jones Industrial Average. Total return of these companies year to date. You can see where the value has been. You know, I think if we had looked at this with the S&P 500, we'd probably find about a dozen stocks that are heavily in the green, and 490 that aren't. And it's not dissimilar here. So you can just see some of these big mega cap tech stocks that have become more mega cap. Specifically Apple and Microsoft leading the charge. So again, this is only 30 stocks, but if we looked at the S&P 500, it's something that would be lacking from the market would be called breadth, Scott. So I guess you could probably comment on that better than I can, but it's usually not a good sign when you have 12 stocks or 10 stocks out of 500 that are really outperforming, and the rest are lagging. That's not a good sign of economic growth throughout the entire economy.
Yeah, and when you talk about breadth, the wider the breadth, the more structurally solid and sound is something like a rally in equity markets. So when it's very specific to a few stocks, that lack of breadth makes the market rather vulnerable. And the fact that the valuations are as high as they are makes everything rather vulnerable, for that matter.
Right.
And you can talk about this chart too, but it's the 13th best year in the last almost 200 years. So
yeah, 190 years.
Yeah. So I mean, it's quite something. But as we all know, more often than not, the balance of the year doesn't bode quite as well as the beginning. Paul, anything you want to add?
Yeah, that's true. But I guess the reason why I wanted to look at this was when we're up, anywhere from, call it 20% to, strip out 1933, but 20 to 30% in the first half of the year. It's like, what does the second half of the year look like? Well, it's not necessarily as bad. I mean, obviously 1987 was bad, but stripping that out, or even including that, I mean, the full year return, there's not a negative year in there. So I don't know. I put that chart in just to balance part of our thought process that we could be in for a real reckoning in the back half of the year. I'm not so sure we will be. That's all I take from this chart. Really, is that it generally, when the market is up 20% in the first half of the year, the second half of the year, 11 times out of 15 is still positive. So we'll see.
All right. Yeah, it could make for some even bigger volatility, I imagine.
Yeah, I agree. Yeah, that's true too. That table doesn't tell us anything about intra-day or week volatility.
Right.
Oh, tactical. Really just a couple comments, but there were no real trades, although we'll talk about one at the end. Couple comments. TransCanada Pipeline, or TC, now we own a very small amount of that stock, but it has not performed all that well. They did sell two large assets. One was, 10 odd billion, one was 5 odd billion. That will largely go towards delevering the company. Enbridge and TRAP run a fair bit of leverage because they have, 90% of their revenue is contracted for 20 plus years. But both those asset sales were at or slightly below what most analysts were expecting of them. That was part of the problem. The real big problem with TRAP has been the Coastal Link build out. And that pipeline is just seeing cost overruns, time overruns, you name it. So that's kind of been bad for TRAP. I don't think we're going to add to it. We do want a TRAP investment grade bond as well. So we're monitoring our overall exposure to TRAP, but neither are big enough to worry about. But I don't plan to add to that position. And I mentioned this, I believe, last quarter, but share it stock and bonds for that matter. But in our balance mandates, most of our risk is in the equity. I did have a conversation with the CFO yesterday to clarify some of their second quarter report and the conference call. Again, it was highlighted to me in no uncertain terms that come February 1st, 2024, they will be free to spend up to 114 million plus of capital to do either share buybacks or pay a dividend. I believe, I'm 100% sure they would do a share buyback at this level. That's substantial. They have about, right now, today, 85 million, or bordering on 100 million today, of cash in Canada. The market cap of this company is only 200 million. So think about that. They have 100 million of cash in the balance sheet, and the market cap's only 200 million, and they could spend up to 115 million buying back stock. So I think that something's going to happen. We definitely need to wait until February because that's when the restrictions come off, and I won't get into those details, but it's related to a bond they have outstanding. So to say I like that position would be an understatement. Of course, what really matters is nickel, cobalt, and fertilizer pricing. The third thing I would mention is Yellow Media. They're reporting, just came out this morning, August 9th at 8:30 in the morning is the call. I'm quite sure what we're going to see according to my cash modeling on this one is some shareholder return again in the third quarter. Coming up sometime in August, September, October, we'll see another either share buyback, which they did a massive one last summer, or an increase of the dividend, which they just increased last quarter, or a special dividend, which I've been pitching them on. So that stock has popped up a little bit, but it's super illiquid, so I wouldn't put anything into that. The only other thing I would mention, Scott, is Auto Canada, yesterday being August 1st, I know one day after the month, but we did sell half our position. We got a good sale off, almost got the high of the day. So we sold half our position in that. And as I've said in the past, it was not really a long-term core holding. So it still has some issues to work through, but it's off 5% today. So I'm happy with that sale. That's it for tactical.
Great job on that.
Yeah, every bit helps.
Absolutely.
Fixed income, again, talking about government bond yields or rates, extremely volatile. But in the end, across the course of the month, 5-year government of Canada's are up about 50 basis points. So that's a pretty substantial move, and we've talked about the reasons why. Our corporate bonds added some value, investment grade less so. High yield, as we mentioned earlier in the call, performed quite well. And finally, the currency was pretty much unchanged across the month, so it didn't really affect our overall performance in the portfolio. That's it.
And just while we're on fixed income again, and I've talked about this before, and I'm going to reiterate it because I continue to have conversations along these lines. But when when you look at your bond, the specific part of your bond portfolio, you need to take into consideration that part of the value of the bond portfolio is not necessarily being expressed in the mark to market, because for the most part, we will hold bonds to maturity, and the actual maturing value or the par value of the bond may be at the moment, because of bond prices being down, significantly less than the actual price or the actual market value of the bond right now. So when you look at the difference between the maturing value and the market value, and you add it up in your portfolio, to a large degree, that may add about 2% of value that you're just not seeing in the day-to-day mark-to-market. So when you look at the value of your overall value of your portfolio, so it's something to keep in mind, especially when you're making comparisons to ETF portfolios. When you have bonds that are in an ETF holding, it's quite different than when you have physical bonds, actual bonds that have a maturing value that, given time, those bonds will actually move back towards. So there's hidden value in everybody's portfolio who has some exposure to bonds right now, and it's always important to have those conversations if you're feeling uncomfortable about where your portfolio is at in a performance perspective. I've had a few of those conversations, but it's always important that you're comparing apples to apples when you're looking at other options.
Scott, that's a really good point. I would just add too, our high yield investors know this in our high yield mandates, and I've highlighted that to them. I actually really like adding to some of that debt right now. And the reason being is because I think rates have largely peaked, not so much in the overnight with the central banks, but certainly out the curve in that 5-year type area where a lot of high yield debt resides, for two reasons. Number one, rates have largely peaked. Number two, our portfolio in the high yield mandate is roughly 23 bonds, and 3 of them are at or above par. The rest are at a discount, some pretty steep. And you can start looking at, decent quality bonds, good quality bonds in some cases, senior secured bonds in a few cases at 85 cents on the dollar. That's, you hold that to maturity and it matures at par. That's 15% or 15 cents on the dollar that you're going to get in capital gains. That's an excellent after tax. You don't see that often in these bonds. So it's to me, it's a great thing to add in right now is high yield. In our balance mandates, we're pretty much fully invested, but for new capital coming in, love it.
And you wouldn't be selling bonds, right?
No.
Yeah. Okay.
No.
Well, thanks, Paul. That was great. And thank you again for your patience. I think that went a little longer than we'd hoped, but I think we've passed on a whole pile of great information. So on behalf of Paul and myself, wishing everybody a great balance of the summer. We'll be back at the beginning of September with our next edition. Until then, everybody have a wonderful time.